Hello, good evening. This webinar is actually a replay. We had some technical difficulties on the original air date of November 30th. Um, so this here is a replay to make sure we get all of the information, and it's being sent out to everyone who registered for this webinar. Thank you so much for participating and for supporting me. And I hope that we both can get something out of this. We all can get something out of this. Also, as of right now, there's no one on the webinar. Again, this is just a recording. There were poll questions scheduled throughout. We will be skipping over those, but we will move forward. This webinar was supposed to be set up for entrepreneurs. Anybody was welcome to join because as employees, there are still others who are able to write off some of the expenses that they incur and they are not reimbursed for. So we are skipping the poll question and moving forward. I would like to introduce myself. My name is Pamela Mitchell. I am an emerging entrepreneur in the field of financial management. Financial management is a very broad term that includes budgeting, life insurance, retirement, among other areas. For me, it covers the realm of tax prep and planning. October marked my 14th year as a tax preparer. I started out in one of the top four tax franchises while I was working on my bachelor's degree. I took a hiatus while working on my master's degree, and after graduated, I started working for another tax franchise. It was at this franchise that I decided that I wanted to branch out and do my own thing, kind of do my own thing. I did it. I felt the need to serve the client as a person and not just someone who is receiving that refund. And that's pretty much where tax prep services have gone to, where it's all about maximizing a refund. And it should be about so much more. And that's pretty much why I started my business, PMMBA. And as it says, this webinar does not cover individual, personalized, or customized financial advice. Okay. So PMMBA LLC is a financial management consulting boutique based in Metro Jackson, Mississippi. I specialize in financial management, performance consultancy, process improvement, and staff development. My foundation in office administration, coupled with my experience in tax preparation, allows for me to have a unique take on bookkeeping and accounting. Because of my background, I'm able to be what I say a one-stop shop where we handle budgeting, bookkeeping, accounting, and tax prep. For entrepreneurs, we all know the statistics for the success or failure of most startup businesses. And my purpose is while people are trying to build a business of a passion, they usually overlook the back of the house where they're actually running it like it's a business. So even though you're doing what you love, you still have to, and if you want to thrive at it, you still have to make sure you are doing what needs to be done to make sure it's a success. So with my experience in project management, office management, and information systems management, I am able to analyze and make recommendations that encourage growth and stability. Listed here is a compilation of the services that I provide. One thing that sticks out is the Microsoft Office section, and I have been able to build that into the services that I provide. As I said before, my foundation is office administration. And something that set me apart from other admins was my certification in Word, Excel, and PowerPoint. As entrepreneurs, there are a number of tools out there whose sole purpose is to increase efficiency in running a business. All of those tools cost money. What we don't realize is that although Microsoft Office may be a bit basic in nature because it anybody could use it, it could easily suffice until a starter starts thriving. So, for example, if you're not ready to commit to a bookkeeping software such as QuickBooks or FreshBooks or Sage or Xero, build your template in Excel, especially if you're starting out as a hobby. If you don't want to spend money on Photoshop, you have the same capabilities in Word and Publisher. You're able to do your own graphics, um, flyers, brochures, and things like that. If you are able to just put something, there are plenty. I've seen plenty of graphic design that looked amazing, and you sometimes you wouldn't even be able to tell it was done in Word or Publisher. So another example, you need somewhere to store your client information. You recall a couple of weeks ago there was a internet outage almost on the East Coast. There were some people who could not have access to their let's see, PayPal accounts, their clientele software, their customer relationship software. So that would be a backup if you could use Microsoft Access. So because people are so content with storing their information online, some people don't even have a backup in place. A great use for building Microsoft Access into your business, just to have a backup plan. And all of this is just if you're starting out. And at some point, you're going to need to progress to something a little bit more advanced or hire a professional. But that's the example of the type of financial advice that I would give. As of right now, if you can't go out and hire a graphic designer, well, Microsoft Office, you can get a $6 a month deal and handle some of this stuff by yourself. Okay, so we're going to kick this webinar off with who's managing your money. I won't be spending a lot of time on this topic because it looks like um, everyone that registered is pretty much established in their entrepreneurial endeavors. And as a business person, I do recommend every business, no matter the size, have these three key personnel on their financial management team. I also understand that this isn't always in the budget. But here's the thing to understand. Although there is some overlap in the duties and responsibilities in each role, there should always be some form of checks and balances. Have an accountant to make sure the bookkeeper isn't robbing you blind, or vice versa. Have a tax preparer to make sure you don't go to jail for something the accountant did. I also recommend that your tax preparer plays a dual role in managing your finances. With everything going on in your life and our business, please don't wait until it's time to file taxes to update your tax preparer. And you may not be their only client. So don't wait until March or April, and we've had plenty of those that will um, put everything in a shoebox and just hand it to you. So here I've listed some key differences basically about the bookkeeper, the accountant, and the tax preparer. So your bookkeeper, they are the easy access person. They record the day-to-day operations. They may handle your accounts payable, accounts receivable. They send out quotes and invoices. They do the financial reporting and handle cash flow. So that's the person, easy access. You're able to ask some questions day by day. The accountant They analyze and verify the information that is gathered by the bookkeeper. They generate reports based on that. They analyze the accounts. They are able to do forecasts and budgets, and they look for opportunities for growth. And yes, your accountant can also be your bookkeeper. But again, it goes back to having the checks and balances in place. Um, you don't want to put yourself in a position where one person is handling all aspects of your business, all aspects of your money, and you don't know how well your business is actually doing. And again, with the tax preparer, I don't just see them once a year. Your accountant could also be your tax preparer. Your bookkeeper could also be a tax preparer. But they basically prepare and submit the federal tax returns and state returns and handle your quarterly taxes. You do not want to. There are plenty of accountants out there that can handle all three aspects of each role. Um, and if you have someone that you trust to handle that, I would say go for it. But don't put yourself in a position where you could possibly be robbed blind, especially if you're a startup and you just thrive and you manage to get to that $100,000 million benchmark. You want to make sure you have, even if you're not able to get more than one person in place, at least know enough about your business, about finances, to where if you can look at it, you can tell if something is not right with your business. Okay, so let's move forward from who's managing your money. This would have been a poll question, and as I said, we're going to skip that because this is a recording on here. Okay, so here we are with record keeping. With record keeping, it's one of the most important responsibilities as a small business. Um, let's see. You want to know what's going on um, in your business. Record keeping is more than just income and expenses. It includes detailed tracking, planning, legal compliance, tax preparation. So for each one with the detailed tracking, owning a small business will require you to track a significant amount of information such as customers, sales, and inventory. This goes back to the Access database that I mentioned um, before. And without a proper record keeping system, you may lose sight of important business details, leading to problems with serving. If you do not know details about your customers, such as who your customers are and what your customers like, you may not be able to meet buyer demand. You risk disappointing a customer, maybe losing that customer forever. So stay informed of customers, their orders, their inventory to provide for their purchases, which can be quite a challenge. And without a proper record keeping system, how does a business know? How does a business owner who fails to track his customer determine inventory needs for the next quarter, year, or for longer? The example I always give is clothing retail stores. Um, Retail stores have to anticipate the need for inventory throughout the year. With that, we are about to start up our winter season now. December, we're in December. We're going into December, pretty soon January, the new year and whatnot. But this is the time, although these are the coldest months of the year, this is also the time where retail stores are preparing to have their clearance sales. Although it's still winter, they are trying to get rid of this to get their spring line in order. You wouldn't know, and without proper record keeping, you wouldn't know what exactly. It's more than just knowing what's in season. You'd have to know if somebody's actually going to buy it. Now, for personal reasons, as a business owner, you should also establish a record keeping system. When applying for a business loan, a lender may want to consider your personal records, such as financial statements, personal checking accounts, savings accounts, anything else that could be tied to your business. So, for that purpose, you want to track all of that. Okay. So we've also gone into planning. I'm sorry, I didn't transition well. So with the planning, that's where that comes from when you're leaving the winter season and preparing for the spring. You have to plan that out properly. Okay. As far as legal compliance, as an owner, you will likely execute contracts and be required to hold various licenses and permits. As an employer, you will be required to maintain and report employee payroll for tax purposes. These three categories of legal compliance are contracts and leases and other agreements, such as copyrights, licenses, insurance and permits, payroll, and personnel. So those are the types of things that you would want to keep in mind to make sure you're being compliant. And again, with the record keeping, you would want to make sure you have all of those things that are readily accessible. So if you have to draw up a contract, you already have a template in place, and you don't have to create one every time you make a new client. For let's say product providers, if you do sell clothing or jewelry, it may not be you may not be issuing out contracts, but you may be under contract to receive goods and services from someone else. And you would want to make sure you have a copy of the contract in case a dispute arises. So, record keeping for tax preparation purposes. A well maintained record keeping system ensures that you are able to keep up with tax reporting requirements. For example, if you're an individual, small business owner, or contractor, then you are generally considered self employed. Self employed owners file a personal income tax return annually and pay estimated taxes quarterly. So, that would be sole proprietorship and an LLC. You are able to file that on your personal tax return, which is a 1040. Everyone files a 1040, but as an entrepreneur, self employed, or a business owner, sole proprietorship LLC, you would still use a Schedule C with your 1040. Now, if you are an S Corp or a C Corp partnership, there are other forms that would be filed with your tax return, and we are not covering that in this webinar. But if you have any questions, feel free to send me an email or give me a call. I'd be happy to look that information up for you. Okay, again, we're skipping the poll question and going into our presentation. So this right here is basically the meat of the webinar, where we are covering and planning out the close out the end of the year, what things can be written off. I have had someone to ask before, what is a tax write-off? I will go ahead and include that. I do believe everyone that signed up for this webinar is pretty much set in that, but just in case, a write-off would be any expense that you incur that would go against the income that you receive. So the government taxes you on the amount of income that you receive, but if you are spending money to make that money, the government says that it can go against that income and reduce your tax liability. Okay. So these are some things that typical tax write-offs, claiming deductions that will save you money by reducing your overall taxable income. You'll be paying the government less. You may be sure of your business costs, but not well versed on which deductions are fair game. And that again is based on the industry that you're in. When it comes to employment, um, one that I use is makeup. So for females, as females, we like to dress ourselves up and look presentable for work. And sometimes for some females, that includes makeup. Well, as an employee, even as an entrepreneur, as someone who's self-employed, if you decide that you want to wear makeup, that is not a tax deduction. That is a choice that you are making. You can do without. Now, if that same female decided that they wanted to model for a living and wearing makeup is a requirement for the job, then yes, that is a tax write-off. You could use that as an expense on your tax return. The example that I use for men, depending on their industry, let's say you're a doctor, you're a high-ranking doctor, and you decide that you want to be a little bit more snazzy, dress yourself up, and you decide to go out and buy a $10,000 suit. Well, although you may see that suit as making yourself more presentable for your job, the IRS just sees it as a want. You just want a suit to look good. You don't need that suit. And as far as the IRS is concerned, you could wear that same suit to church every Sunday. So no, if you cannot use it exclusively for your job or your industry, and it is not a requirement, it does not always count as a tax write-off. So those are the two examples that I usually give, but on here I have a couple of things that the IRS may consider to be tax write-offs. With startup costs, whether the majority of your startup costs are related to your office supplies, team, business operations, or travel, these are some key deductions. You can use them to get your maximum refund and establish a good expense tracking habits. Okay, so to go through here, we have you could go up to up to $5,000 of startup costs. Um, Office costs, rent, furniture, office costs, cafeteria costs, web services such as internet, email, mail services, postage, stationery, home office, operating costs, cell phones. With cell phones, that has changed over the years. But one thing, I think the most recent is that now with a cell phone, because before it was whatever percentage of the phone time that you use goes towards the business, that is the percentage of the phone bill that you are able to use in your taxes. So if you have one phone line and 40% of the time you use it for business calls, then you are only able to deduct 40% or 30% or whatever that percentage amounted to be. That may have gotten to be a bit too tedious because it looks now you may be able to deduct half. So if you only have one phone bill, one phone that you use for both business and professional purposes, just split it down the middle, half for personal, half for professional. If you have one personal line and you have a separate line for business costs, business purposes, you are able to deduct the full um, expense of your cell phone. And the other ones are pretty much self-explanatory for operating costs. Team expenses, they're pretty much well known, and travel and entertainment. One of the most overlooked expense is mileage. You are supposed to keep up with your mileage from January 1 to December 31. Both, I'm sorry, not both, but all three of personal, business, and commuting. And again, that would give a percentage of the use of your vehicle for business purposes. And as with the cell phone, it's determined by, if you only have one vehicle, it's determined by that. It's determined by your mileage. So if you do 10,000 miles for the year and 30,000 is used for business, then that's 30% of your, I'm sorry, if you have 10,000 miles and 3,000 are used for business, then that's pretty much what 30% of your mileage, 30% of your vehicle expenses would be able to be written off on your tax return. Okay. We're skipping the poll question. What was that one going to be? Okay. Tax planning. This is what this entire webinar has been planned for. The purpose of tax planning is to make sure um, you get all of your information together and properly prepared so that you are able to use it to grow your business in the future. What I have here um, is a list of mistakes that most individuals make as entrepreneurs. So with this, we are able to, knowing this information, you're able to plan out how you can address issues as they come about. So here we have tax planning is a year-round process. Even if a small business owner has a professional handling their taxes, it is the owner's responsibility to collect and organize documentation. One of the biggest tax mistakes a small business owner can make is not keeping receipts for all expenses. These receipts are necessary to verify purchases to deduct from the business's taxable income. So, not keeping documentation for expenses. How to avoid making that mistake: invest in a tax diary or organizer to keep all expense records in one place. The business purpose of each expense. So, what one could do is um, most importantly, keep up with the date, the purpose. If you're meeting with the client, who is that client and what was the purpose of it? These are things that we covered. If you used your vehicle to travel, keep up with your mileage. I started my vehicle On such and such miles, I traveled to this destination. That was a total of such and such miles. So make sure you are keeping a record of that information. Another mistake is not knowing current tax laws. Small businesses are faced with a variety of taxes, which can be a shock for many startups. Aside from the well known federal income tax, state and payroll taxes, small businesses can face various taxes they never knew existed. When a business overlooks or misfiles some of these taxes, the penalties can be costly. So, with tax laws, tax planning, make sure you meet with a tax professional year round, maybe on a quarterly basis to stay up to date on changes in tax law. Even as tax preparers, we are informed around this time, October, November, December, to implement things before the tax season. Um, but that is one of the uh, requirements as a tax professional. That's something that I did not mention earlier about the qualifications of a tax preparer. There are different levels of tax preparers. Um, the only thing that basically keeps them tied together, the only requirement that every level has is a PTIN, which is a basically an identifying number that lets you know. Now, if you have a tax preparer that is requiring you to make a payment to prepare their taxes, they are required to have a PTIN, personal tax identification number. I believe that's what that stands for. That is the requirement set forth. If we are being compensated for preparing taxes, we must have that identifying number. If someone approaches you and says that they are able to do their taxes, ask them if they are registered with the IRS. If they say no, then you do not have to pay them. You do not have to pay them. They are more than welcome to do it for free, or you are more than welcome to go and find someone else who is registered with the IRS if you are going to pay someone. And there are other things. I give that as a seminar year round. I think I will follow up in the beginning of January on how to choose a tax preparer. I believe I will do that. So look for that in your email box. Okay. So, not handling deductions properly. We're going to move on to the next. Small business owners can run into trouble when calculating deductions without knowledge of limits. The IRS allows business gift deductions of up to $25 for any individual. When businesses file a four-digit deduction for business gifts, it mistakenly reads as though a person gave deductible gifts to at least 40 different people. Um, so, to avoid this, find out all deductions you qualify and learn the rules regarding limits for specific deductions. Another example of that would be on the personal side would be medical expenses. When you itemize, and most people try to itemize using medical expenses, there is a 2% minimum, a 2% limit on that. So if you have medical expenses, you pay doctor's bills, you paid your insurance throughout the year, and you want to try to use that on your taxes, anything over 2% of your adjusted gross income is allowable. You have to meet that threshold. If you do not, then you won't be able to use that. So that's something else that people should be aware of when trying to um, make sure they have tax deductions in place, or are they eligible to use that. So know what deductions you are able to use and if there are any limitations on those deductions. So next we have confusing office equipment with supplies. Office equipment such as computers and printers is usually considered a capital expenditure, which faces special tax rules and has to be depreciated. If a business deducts computers as supplies, the IRS can rule that the business isn't entitled to the deduction because it improperly categorized the expense. I do believe they've gotten a little bit more lenient on that. You can hop out onto Walmart and purchase a computer and a printer for about $30 now. So that would be a supply, and it would not need to be depreciated, even with computers. So the IRS is getting a little bit more lenient on that. I don't know the dollar amount for computers, but they are now allowing full amounts to be written off. So if you purchase a computer, you don't have to stretch it out over a 3 or 5 or 10 year expenditure. You don't have to stretch it out over such a time frame. You are with certain dollar amounts, you would be able to deduct the full expense in the year that it was incurred. So if you bought a computer back in 2014 and you're now getting to a point you are still using that same computer, but you're now getting to the point where you are at a position to actually use it on your taxes, well, no, you won't be able to do that. You have to use the expense in the year that you purchase it. If you buy it in 2016, you can write it off on your taxes for the upcoming tax year. If you bought it in 2015 and you were not able to put it on your tax return for this year, go back and amend your 2015 tax return. Tax planning would also, moving on, tax planning would also put you in a position to better understand your finances so that you are not borrowing from your employee withholding. It can be tempting for small business owners to dip into employee Social Security and income tax withholding to pay bills. However, small business owners assume personal responsibility for those funds. The IRS carefully audits the payments of trust fund taxes, and in the event of a tax audit, this could result in huge potential penalties. And another thing with that is once that money has been deducted from that employee's pay, it is then the government's money. It is no longer your money as a business because you are supposed to be remitting that payment to the government. So in tax planning with that, to avoid borrowing from your employee withholding, plan ahead so there isn't a shortfall at the end of the month. Meet with an accountant at least once or twice a year. Again, I recommend maybe quarterly to go over where problems are likely and how to avoid them. Tax planning for your employees. This has been something that has become sort of a hot topic. Companies are being penalized for this. Businesses may classify employees as independent contractors so they won't have to pay payroll taxes on them, cover them in pension plans, or provide them with medical insurance. So, not classifying your workers properly, um, you could be heavily fined on that. So, if the IRS ever begins a payroll tax audit, businesses may have to pay payroll taxes for those misclassified employees going back 3 years, among other penalties. So know the difference between an independent contractor and an employee. If someone is on a set schedule Monday through Friday, 8 to 5, they are an employee. If you hire somebody for a one-time project, it could be kind of iffy if they're a part-time employee, part-time short-term employee, or if they're an independent contractor. And then there are some jobs that yes, it is definitely an independent contractor. So to make sure you are planning correctly for that, check with an accountant or tax lawyer before filing someone as an independent contractor to make sure it's justified. assigning unreasonable compensation. So with that, what's been happening is at the end of the tax year, the business has done so well that the owner feels that, I can, with this money that I made, I could just make that my salary. Well, no, you can't really do that. Pay yourself that way, and that I think that's more for the corporations, S corps, C corps, because as an LLC, that's all your money anyways. But still, make sure you have a separate account. You have a business account and a personal account. Keep those funds separated. And if you need, you could consider it to be paying yourself as a personal expense, but it is still your money because it's still on your 1040 tax return. But in the case of a corporation, small business owners may be tempted to increase their salaries by nearly the total amount of profit. No, you are not able to do that. The owner will move profits into salary in part to take advantage of deductions for salary payments. However, the IRS will look to a company to determine whether the owner's salary is reasonable compensation based on the business, the industry, how much work the owner does, and how much similar businesses make. So do not put yourself in a position where your company, your business has made a nice sizable profit for the year and you decide that that's your salary. So if you do want to increase your salary, if you find yourself in a position where you've made that nice profit and you want to increase your salary, you'd have to substantiate a reason for the salary increase, or the IRS may disallow part of the money as unreasonable compensation. Basically, what's in the business stays in the business. Pay yourself a salary, a set salary. And next, what we have on tax planning, not thinking of consequences. Everything that you do, everything that you do in life, it has a consequence, whether good or bad. Um, for tax purposes, this is mostly about interest and penalties. The IRS, this is basically how the Internal Revenue Service makes its money, interest and penalties. Um, interest from interest and penalties from fraudulent tax returns, whether intentional or not, can be expensive. In the long run, if interest I'm sorry about that. Interest and penalties from fraudulent tax returns, whether intentional or not, can be expensive in the long run if interest typically dates back to the original filing date. So it's not a matter of when the mistake was caught, it's a matter of when the mistake was made. And with the IRS, they've had it set they could go back 3, 5, or 10 years depending on what your business is. But if they find a mistake, and then finding a mistake in a certain year would justify them going back even further. So if you made a mistake on your 2012 tax return, but the IRS didn't catch it until 2015, well, it's going to start. The interest and penalties will be backdated for the 2012 tax return. It won't just start when the mistake was found. So keep that in mind, and the best way to address that is to make sure, as the business owner, you always review the tax return before it's filed. And that brings to mind something else when it comes to the tax preparer. Regardless of what the tax preparer does, it is ultimately still the responsibility of the taxpayer So I tell everyone, always, always, always look at your tax return before it is submitted. If you see something on there that does not look right, do not move forward with it because you're still ultimately responsible for that. An example of that would be a case that was out of Texas, I believe it was Texas or California, where a couple with some kids, they went to the tax preparer. Tax preparer did the tax return, submitted it to the IRS, and it was a fraudulent tax return. There were things on there that did not belong. So if you've been enrolled in college, if you have not been enrolled in college and you see education credits on your tax return, that is a red flag. And if you see it and don't say anything, that's one thing. But if it's on your tax return and you did not look at it to verify that the information is correct, that's still something completely different. But in each instance, the IRS is still holding you personally responsible for that information. So if you receive a refund based on that education credit, knowing that you were not enrolled in an institution of higher education, you are still responsible for paying that money back. But that's on a personal note. The same thing applies um, for your business if they because most businesses they could qualify for business tax credits. If you and you may not know enough about it, but if you see something on your tax return that you are not quite familiar with, make sure you question the person that is submitting your tax return so that you can understand what is going in, what is being submitted to the IRS. Okay. Question. Okay, that final poll question was supposed to be about how often you meet with your financial advisor. Again, I recommend at least quarterly. You can meet once a week if you want to, once a month, but have set of a sense of consistency when meeting with your tax preparer, your financial advisor, if it is the tax preparer or the bookkeeper or the accountant. Um, as I said earlier, you have the bookkeeper who is um, easy access day to day. Accountant, maybe you can do them once a quarter. Your tax preparer um, should be either the bookkeeper or the tax preparer, and that is my personal opinion. Don't and what I've seen too many times in uh, in the tax prep world is that what we've called shoebox clients, they just start storing all kinds of receipts and just throwing them in a shoebox or a Ziploc bag or something like that, and then they take it to the tax preparer when it's time to file taxes. Oh, first of all, that tax you are not the only client that the tax preparer has. Um, so make sure you're not uh, dumping everything on them and expecting a quick turnaround. They have multiple clients, and they want to give a high quality service. So make sure you give them adequate time to submit that information. You also again want to make sure you're meeting with them more often because if there is a life changing event, especially if um, you you had a baby. You can have a baby in less you in less than 12 months. So if you file your taxes in February and then you have a baby in November, and then and you haven't been keeping your tax preparer aware of anything, and they don't have all of your information, and you don't have the information. What we mostly ran into is somebody had a baby in October, November, December. Social Security card hasn't come in by the time they want to file taxes, and if you don't tell the tax preparer that you've had a baby, and then you're missing out on tax deductions in that aspect. But again, that's from the personal side, and if you are filing an LLC or sole proprietorship, that is still something that affects your tax situation. So meet with your tax advisor, your financial advisor, both personal and business purposes. Okay, so for everyone that registered, For the webinar, I have a deal of the day. Schedule your appointment. You get a $200 discount on a profit and loss report with the purchase of an initial consultation. And that consultation will include an assessment of your record keeping process, file organization, a backup of all related files, and a financial standard for the calendar year 2016. The original price on that um, could run almost $500. So to get that $200 discount, you would it's a significant savings, especially if you have not made preparations to close out your tax year. So to those that signed up for this webinar, I will be sending this out to you within the next day or so. It would be great, especially if you have big things planned for next year and you want to put them into place. Know where you stand financially. If you don't have anybody that you can talk to about these things, I am here. You can email me. You can give me a call. I'd be happy to help you out with that. And this offer is good through December 16th. $200 off of a profit and loss report with the purchase of an initial consultation. I also offer package deals if you need help with that, where I am able to manage your finances. We have bookkeeping, accounting, and your tax prep. Tax prep is not included in any package. So I did not write that down. Let me make sure I email you guys about how to choose a tax preparer. If you do not have anyone in mind as of now. So also the package deal is record keeping with the bookkeeping, with accounts payable, accounts receivable, sales forecasting, budget forecasting. I also hold workshops throughout the year on our tax season. And with the Microsoft Office sessions, those are scheduled throughout the year also. An example of that would be, as I mentioned earlier, using Microsoft Access as a customer relationship management system, where you are able to manage aspects of your business without, as a backup. I will say that as a backup, because there are plenty of free tools out there. An example would be MailChimp. But if at any given point the internet were to go out, because we've had it to happen just in October, got to mention that again, you at least have a backup of all of your information. So with that being said, with the original webinar, there were not too many questions. I don't have any, there were not any questions submitted via email to me. And when I originally set this webinar up, it was set up for an hour and a half, so that I would make time for the Q&A session. So I am right at 1 hour, 4 minutes. So I did the webinar, and again, because this is a recording, I don't have any questions from any viewers. This webinar is being emailed out to you. I really appreciate everyone for signing up and supporting. Thank you for being there. I am planning big things for 2017, and I hope that you are all a part of that. If you have any questions, here's my contact information. I would love to help out. Schedule an appointment. I look forward to hearing from everyone. All right. Thank you so much.